Ethereum's growing role as a foundational element in global finance was highlighted at the Ethereum Community Conference, ETHCC in Cannes, France. Key financial institutions like BlackRock, Deutsche Bank, Coinbase, and Kraken are increasingly building on Ethereum's infrastructure, showcasing its potential to transform traditional finance. Notably, Robinhood became the first publicly traded U.S. company to launch tokenized stocks using Ethereum's Arbitrum network, signaling a significant shift towards integrating blockchain technology into mainstream financial services. This move propelled Robinhood's stock to new heights, reflecting strong market confidence in its innovative strategy. The conference underscored Ethereum's evolution from a niche experiment to a critical component of institutional finance. Ether, Ethereum's native token, experienced a 6% rise during the week, with related equities such as Bitmine Immersion Technologies and Bit Digital seeing substantial gains. Despite Ether's 20% decline year-to-date, rising ETF inflows suggest renewed institutional interest, driven by Ethereum's utility as a stable and reliable transactional platform. Deutsche Bank's development of a tokenization platform on Ethereum's zkSync layer and BlackRock's on-chain money market fund further highlight Ethereum's growing appeal as a robust financial infrastructure. As Ethereum solidifies its position, the focus is shifting from speculative trading to its practical applications in finance. The network's stability and dependability are key factors attracting institutional adoption, as noted by Ethereum co-founder Vitalik Buterin. While newer blockchains offer faster speeds and lower fees, Ethereum's established trust and functionality continue to attract significant interest from major financial players, positioning it as a cornerstone of the future financial ecosystem.
On July 5, 2025, Indian equity markets closed positively, with the BSE Sensex rising by 193.42 points to 83,432.89, and the NSE Nifty 50 gaining 55.70 points to settle at 25,461. This uptick occurred amidst global economic uncertainties and investor caution ahead of a looming July 9th deadline for potential U.S. tariff impositions, a remnant of trade policies from the Trump era. Despite the volatility, a 0.57% decrease in the India VIX to 12.32 indicated a temporary easing of investor anxiety. Sectoral performance in India was led by the Nifty Oil and Gas Index, which rose by 1.05% due to optimism around crude price stability and demand recovery. Gains were also seen in the realty, pharma, and IT sectors, while the Nifty Auto and Metal indices experienced profit booking. Notable gainers among Sensex constituents included Bajaj Finance, Infosys, and Hindustan Unilever, whereas Tata Steel and Maruti Suzuki lagged. Investors remain vigilant of global trade policies and upcoming inflation data, which could affect short-term market movements. Globally, equity markets experienced mixed reactions as the July 9th tariff deadline approached, with European indices like Germany's DAX and France's CAC 40 declining by 0.8% and 1.1% respectively. This reflects concerns over unresolved trade negotiations between the U.S. and its partners, which could trigger market instability. Despite this, U.S. stock indices such as the S&P 500 and Dow Jones Industrial Average continued to reach record highs, buoyed by strong domestic economic data and corporate earnings, although futures showed a slight 0.5% dip in pre-market trading. Investment analysts warn of potential market wobbles if substantial progress in trade talks isn't achieved soon. The expiration of the 90-day tariff pause, which had set a 10% baseline tariff rate, raises concerns as negotiations with major economies like the EU, India, Canada, and Japan remain unresolved. The possibility of tariffs reverting to higher levels could pressure global markets, impacting GDP forecasts and earnings estimates. Analysts advise investors to remain calm and avoid panic selling, as markets have historically rebounded from tariff-induced downturns.
H&R Real Estate Investment Trust, REIT, one of Canada's largest REITs with assets totaling approximately $10.5 billion, has confirmed the formation of a special committee to explore strategic alternatives following unsolicited interest in acquiring the company or its assets. The special committee, comprised of independent trustees, is evaluating multiple non-binding proposals with the assistance of financial and legal advisors, including National Bank Financial and Fasken Martineau Dumoulin LLP. This process underscores the REIT's commitment to its long-term strategy and strategic repositioning plan, focusing on residential and industrial properties while divesting office and retail assets when market conditions are favorable. The potential sale or restructuring of H&R REIT could significantly impact the real estate market, particularly in Canada and the U.S., where H&R holds a diverse portfolio of residential, industrial, office, and retail properties. The outcome of this strategic review could influence market sentiment and valuations within the REIT sector, as investors anticipate possible shifts in asset management and ownership structures. However, the REIT has emphasized that no definitive decision or agreement has been reached, and the process remains subject to uncertainty, including the timing and terms of any potential transaction. Stakeholders are advised to monitor developments closely, as further updates will be provided in accordance with securities laws.
Negotiations between India and the United States on a new trade deal have progressed, with Indian officials, led by Special Secretary Rajesh Agrawal, recently returning from discussions in the U.S. The talks are centered around establishing an initial agreement focused on goods, with both nations aiming to secure favorable terms. However, exemptions for sectoral tariffs on steel, aluminium, and auto components are unlikely to be included in this interim arrangement. Indian Commerce Minister Piyush Goyal emphasized that the negotiations are not bound by deadlines, and that any agreement will prioritize national interests and a mutually beneficial outcome. As part of the ongoing negotiations, the U.S. is seeking greater access to Indian agricultural and dairy markets, sectors that India is particularly protective of due to concerns over rural livelihoods and food safety. Conversely, India is advocating for tariff concessions on its labor-intensive exports, such as garments, footwear, and leather, which are crucial for job creation in the country. The outcome of these negotiations could significantly impact trade dynamics between the two nations, potentially influencing market access and economic growth in key sectors.
Gold is witnessing a potential transformation in its status among critical minerals, traditionally dominated by metals like lithium and copper, due to geopolitical and economic shifts. The recent return of Donald Trump to the U.S. presidency has triggered a global reassessment of the safety of U.S. assets, with concerns about the Federal Reserve's independence and U.S. fiscal policies. These uncertainties have fueled a reevaluation of gold's role as a safe haven, leading to a 32.3% increase in its price from November lows to a peak of $3,500.05 an ounce in April, before settling at $3,357.08. The World Gold Council's survey indicates that 95% of central banks plan to increase their gold holdings, reflecting a growing lack of confidence in U.S. assets. This shift is also benefiting gold mining companies, whose shares have outpaced the metal's price gains. Major producers like Newmont, Barrick Mining, AngloGold Ashanti, and Gold Fields have seen significant stock increases, driven by expectations of higher dividends and capital discipline. Investors are starting to re-rate these companies, anticipating gold's elevated role in investment portfolios. As the global economic landscape evolves, gold and its miners may enjoy a more prominent position, with central banks repatriating gold holdings and investors seeking alternatives to U.S. Treasuries amidst concerns over U.S. fiscal stability.
The London IPO market has hit a three-decade low, with only £160 million raised in the first half of 2025, according to Dealogic data. This marks the lowest half-year total since the data collection began in 1995, highlighting a significant downturn in London's ability to attract new listings. The largest IPO in this period was the professional services company MHA, which raised £98 million, accounting for over 60% of the total proceeds. In stark contrast, the U.S. market saw 156 IPOs generating $28.3 billion, underscoring London's declining appeal as companies increasingly opt for overseas markets. The trend of companies looking beyond London for their IPOs is evident, with high-profile firms like Shine and Cobalt Holdings abandoning plans for a London listing in favor of markets like Hong Kong and New York. Additionally, established London-listed entities such as Wise are shifting their primary listings overseas, citing better access to capital and increased market visibility. Despite the current challenges, there is cautious optimism for a turnaround, with reforms and government pledges aiming to revitalize London's capital markets. the Financial Conduct Authority's recent efforts to streamline the listing process and the potential debut of companies like Norwegian software firm Wisma offer glimmers of hope for London's financial future.
Yum Mining, a prominent player in the cloud-based cryptocurrency mining sector, has introduced an AI-powered optimization engine poised to revolutionize crypto mining operations. This sophisticated upgrade enables users to automate decision-making by analyzing over 70 data points, such as coin volatility and energy prices. This innovation allows clients to optimize mining cycles effectively, enhancing returns without manual input. The CEO emphasizes that this technology aligns AI performance with financial goals, offering a more precise and dynamic approach to crypto mining. The company's commitment to sustainability is evident in its operations, which are powered entirely by renewable energy across its 100-plus global facilities. This eco-friendly model not only ensures profitability, but also addresses growing investor concerns about environmental impact. With a user base of over 7 million across 180 countries, Yum Mining's transparent income reporting and AI-driven strategies position it as a leader in democratizing crypto mining. As the market seeks stability amid volatility, Yum Mining's innovative approach offers a compelling, sustainable, and accessible solution for modern investors.
The recent debanking scandal involving notable figures such as Nigel Farage and businesses like Mackie Motors has highlighted significant issues within the financial services sector regarding the arbitrary cancellation of accounts. In 2023, Farage's accounts were closed by Coutts, a NatWest-owned private bank, not for financial reasons, but due to perceived misalignment with the bank's values. This incident sparked public outrage and led to the resignation of NatWest's CEO, Dame Alison Rose. The scandal has intensified scrutiny on banking practices, raising questions about the power banks wield and their accountability mechanisms. Monzo, another bank facing similar accusations, has been criticized for its opaque account closure processes, further fueling the debate on transparency and fairness in banking. The plight of Mackie Motors, a Scottish car dealership, underscores the broader impact of such practices on small businesses. Owner Kevin Mackie claims RCI Bank, now Mobilize Financial Services, unjustly terminated franchise agreements based on unverified allegations, jeopardizing the livelihoods of 75 employees. This case, unlike Farage's, has not received the same level of public attention or regulatory intervention, highlighting a disparity in how financial institutions' actions are scrutinized. The ongoing legal battle and lack of accountability from RCI Bank emphasize the need for greater transparency and equitable treatment in financial services. The situation serves as a stark reminder of the influence banks have over economic participation and the urgent need for reforms to protect both individuals and businesses from arbitrary financial exclusion.
The Social Security Administration, SSA, has lauded the passage of President Donald Trump's One Big Beautiful Bill, a significant piece of legislation that introduces major tax breaks for seniors. This bill, part of Trump's broader budget reconciliation efforts, includes provisions to permanently extend individual tax rates established in 2017, enhance border security funding, and create new tax deductions. A notable feature of the legislation is the exemption of nearly 90% of Social Security beneficiaries from paying income taxes on their benefits, marking it as a landmark change by the SSA. This move is expected to provide substantial financial relief to millions of retirees, allowing them to retain more of their Social Security income. The bill, which narrowly passed the House with a 218 to 214 vote, awaits President Trump's signature to become law. It offers a $6,000 tax deduction for seniors aged 65 and older with incomes below $75,000, and a $12,000 deduction for married couples earning under $150,000. However, these deductions phase out for individuals and couples with higher incomes. While the legislation significantly benefits upper-middle-class retirees, it offers little to those living in poverty or with incomes above the phase-out thresholds. The tax breaks are set to begin in the 2026 tax year and will last through 2028, aligning with the end of Trump's term. This legislative change is anticipated to shift financial dynamics for many seniors, potentially influencing their retirement planning and overall economic security.
The Securities and Exchange Board of India, SEBI, has taken decisive action against Jane Street Group, a leading U.S.-based trading firm, by prohibiting its access to India's securities market. This move comes in response to allegations that Jane Street engaged in manipulative trading strategies that impacted the Nifty 50 index, a key benchmark of the Indian stock market. Specifically, SEBI's investigation suggests that Jane Street executed a series of trades designed to artificially influence the index, involving aggressive buying of BANK and IFTY stocks and futures, followed by significant sell-offs to profit from options betting on a market decline. SEBI has impounded a substantial sum of 48.4 billion rupees, approximately $566.3 million, from Jane Street, which it claims are illicit profits derived from these trades. The regulator has further instructed banks to freeze any debits from the firm's accounts without prior approval. Jane Street, however, disputes the findings and plans to engage with SEBI, emphasizing its commitment to regulatory compliance across its global operations. This enforcement action highlights SEBI's robust stance on safeguarding market integrity and protecting investors from manipulative tactics, potentially setting a precedent for future regulatory actions in the Indian financial markets.